F. You're new to the stock market. This video is exactly what you need. Remember, every seasoned investor started right where you are. Before we start, please help us to like and subscribe to support us continue making great finance and investment content for you. Let's dive right in. It's an honor to guide you on your stock market journey, helping you achieve financial success and freedom. Hey everyone, and welcome to the Investment Diary. Today, we will be covering Stock Market for Beginners, Ultimate Guide. What we'll cover today, it's similar to home prices. Generally, real estate tends to increase in value. You know this, but let's make it clear with some numbers. You don't need to absorb all this information at once, so feel free to subscribe and watch this video at your own pace, piece by piece. Why invest in the stock market? You should invest in the stock market because it's a proven way to grow your wealth. Just look at the historical data. Over the past 30 years, the stock market has gone up by an average of 9.9% annually. Looking back 50 years, that number is 10.8% per year. And over the past 100 years, it's an average annual return of 10.5%. I want to be upfront. Yes, stock market crashes happen, but consistently, over time, the stock market recovers and keeps going up. 100 years ago, the median home price was $3,200. 50 years ago, it was $33,000. 30 years ago, it was $126,000. And today, the median home costs approximately $400,000. It just keeps climbing. And it's the same with the stock market. The reason financial assets like properties or stocks continue to rise is partly due to inflation. However, the stock market does outpace inflation. Ultimately, you want to put your money to work by investing it. And the stock market has a proven track record of growing your money. Don't throw your money into stocks if you don't grasp the fundamentals. In this section, I'll explain. You need to find investors, and a great place to find them is in the stock market. You probably own a very small piece, but you are still technically an owner. Therefore, no single person owns Apple, Google, or Tesla. These companies have thousands of owners. Who are the stockholders? To participate, you need an online brokerage account. There are many great options. I'll leave a link below to some online brokerage accounts that offer sign-up bonuses with zero fees. No catch, completely free, and some bonuses can be substantial. So check them out. To raise significant capital for your company, you sell a portion of your ownership to investors. That's what stocks are. They're simply units of ownership in a company. Understanding the stock market basics. If the company's value increases, the price of your stock goes up. You might sell for various reasons. To cash out, because you no longer like the company, or to use the money to buy a different stock. You're free to do as you please. And again, this is all free. No fees, zero commissions. I'll tell you what most people do, and you can decide which style appeals most to you. When you sell, the money will be in your brokerage account, and you can transfer it back to your bank account whenever you want. Let it sit there or use it to buy more stocks. In many cases, if a company is making a lot of profits, it will take those profits and pay a dividend to its stockholders. You don't have to do anything to collect the dividend. It just gets deposited into your account, which is pretty awesome. This is passive income in its truest form. It's essential that you understand how the stock market works. Traders aren't interested in holding a stock long-term or watching a company grow. I'm not saying this in a good or bad way. People speculated on Tesla early on and made a lot of money. The same could be said for Amazon or Walmart. There's no single right answer or method. Whichever path you choose, understand its pros and cons. But many others speculated and lost a lot. If you're going to speculate, do not invest too heavily in one stock and do not fall in love with a stock. I say this because of risk and reward. If you invest in a smaller, unknown company, there's a higher probability you could lose a lot of money. As a beginner, you should get a feel for the stock market. An index fund is a collection of stocks, like a big basket where you get instant diversification. It's a way for you to buy a little bit of almost everything, which significantly decreases your risk. Take it easy and just learn. Once you gain more experience and knowledge, then you can slowly move out of your comfort zone into stocks that offer more risk and reward. There will be companies focused on U.S. sales and multinational corporations. Just so many options. The stock market is not a get-rich-quick scheme. In the stock market, you want to be an investor, not a gambler. I want to see you make money as a beginner. It's better for you to make a little bit of money than to lose money. So, I recommend sticking with safer stocks to start and learning little by little. Slow and steady wins the race, and it's a marathon. Your emotions can cloud your judgment. For beginners, I strongly recommend refraining from trading with large amounts of money. Get some practice first. Many investors take their dividends and reinvest them to get more dividends, accumulating wealth over time. This is an excellent way to build passive income. I'm personally a big fan of dividend investing because you literally get paid for doing nothing. Your money is making you money. While many professionals get rich by trading, that comes with significant experience. Some even hold until they die and pass them on in their will. This is a set it and forget it approach. What stocks are, how to invest in stocks, how people get wealthy by investing. What stocks are best for beginners. Let's get started. The stock market is simpler than you might think. What are stocks? Let us say you own a business and you want to raise a lot of money to grow and expand. What do you need to do? So, if you buy stock in Apple, Google, or Tesla, you are an owner of that company. How to invest in stocks? The stock market is a big marketplace where you go to buy and sell stocks. Here's how it works. 1. Open an account. 2. Transfer money from your bank account to your brokerage account. 3. Once you have money in your brokerage account, you're ready to buy stocks. You want to buy stocks in good companies? Why? Because if a company does well, its value increases. If you want to sell your stocks, it's very easy. How people get wealthy in the stock market? Many people get wealthy in the stock market. And there's not just one way to do it. Buy and hold dividend investor, speculator, asterisk trader. Let me explain these styles. Buy and hold. Some people simply buy stocks and hold on to them for a very long time. Years, even decades. Traders. These individuals try to buy and sell frequently to make quick profits. Speculators. These are people who buy smaller, riskier stocks that have high potential to skyrocket in price. Dividend investors. Some people primarily buy stocks for the dividends. You should know from the outset which style appeals most to you. Best stocks for beginners. You'll encounter so many stocks to choose from. Small companies, big companies, companies in different sectors like energy, technology, real estate, retail, banking, pharmaceuticals, and more. As a stock market beginner, I suggest you invest in bigger and more stable companies. If you don't want to take this advice and jump straight into risky stocks, then please, I beg you, do so with a smaller amount of money. Just so you know, if you want to be very safe and diversify, you can always buy index funds. How to invest your money? 2 options in the stock market. You have choices for how to invest your money. Let me give you 2 main options, and you can decide which method you prefer. Option 1. Stock picking. If you choose to stock pick, it's important to spend time monitoring your chosen stocks to ensure everything is going well. Later in this video, I'll teach you more about stock picking. You can search for good stocks to buy. This is known as stock picking, where you're trying to pick the winners. Option 2. Index funds or ETF. If you don't want to become a stock picker, you can invest in index funds or ETF. Investing in an index fund or ETF is like buying a little bit of all the stocks in the stock market. There are pros and cons to this approach, which I'll tell you about right now. Today, I'm teaching you about index fund investing, which includes asterisk. What is an index fund? Pros and cons. Asterisk. Index funds versus ETFs. For example, the S&P 500 is an index of the 500 largest publicly traded companies in the U.S. The thing is, you cannot invest directly in an index, but you can invest in an index fund. How to invest in them? Let's start with what is an index. An index is simply a grouping of stocks, bonds, or other securities. That index fund will buy shares of stock in all the companies in the S&P 500. For example, if there are some stocks that you don't like in the fund, unfortunately, you're stuck with them. It's take it or leave it. But now let's talk about the good stuff, because there are a lot of benefits with index fund investing. This means if there are underperforming stocks in the index fund, you can't cut your losses or have them sold off. Therefore, the index fund will mirror the performance of the S&P 500. You can become a passive investor, which is great for someone new to the stock market or inexperienced. However, active management generally outperforms passive investing when the stock market or an index is going down. Diversification is so important for your investing portfolio because it lowers your risk. To review, the benefits of investing in an index fund include passive investing, dependable returns, and diversification. The drawbacks are you cannot outperform, lack of flexibility, and tracking errors. Index fund investing provides you with a simple solution because when you buy an index fund, you're buying a slice of up to hundreds or thousands of companies at once. Diversification will balance your risk and your portfolio will experience less volatility. Sure, the trade-off would be that you're not going to be the next Warren Buffett. Let's just say the S&P 500, right? Because when people talk about index funds, they usually think about a very broad index. However, you can use targeted index funds to complement yourself as an investor. As an active investor, for example, if I am going to be actively participating in the stock market, like I am looking at stocks every day, not necessarily buying or selling every day, if you invest in a well-diversified fund, you may only need to own 1 or 2 index funds. You can successfully pick your own stocks, invest in index funds, invest in ETFs, or a combination of these. I recommend that you choose what is best for you. And to make that determination, it's important that you understand the differences between the 3. Stock picking, index funds, and Personally, in the stock market, I do all 3. I invest in index funds, I invest in ETFs, and I pick my own stocks. However, if you invest in an index fund that's more targeted, You may need to own more than one or two in order to create diversification. But I am staying up to date as an active investor in the stock market, and I am buying stocks in all different types of sectors. But I feel like I'm lacking exposure in, let's just say, pharmaceutical stocks. Okay, are you trying to be the next Warren Buffett? If that's the case, then I could use index funds, a targeted index fund that specializes just in pharmaceutical stocks, to complement my overall investing style. And you package them all up into one bundle, and you did that 10 times. That's it. That's the difference. So you need to ask yourself those types of questions and be honest with yourself. Because if you are, then index fund investing is probably not for you. It's not a good fit for you, not with the goals you're trying to achieve. You could think of it like this. Let us just say you bought all the stocks in the S&P 500. An ETF is a collection of securities that are traded between investors. And I say to you, hey, can you sell me one of those? And you're like, yeah, sure. Both an index fund and an ETF offer you a low-cost solution, diversification, and a proven track record. This means there's no human actively choosing what to invest in. The four biggest differences between an index fund and an ETF: minimum investment requirements, expenses and fees, and taxation. With an index fund, you can only buy or sell at the end of the day. Therefore, an ETF is more liquid. This probably won't make a big difference for most long-term investors. To cash out of an index fund, you have to redeem it from the fund manager, and the fund manager will have to sell some of the holdings to get the cash to pay you out. So if there is a gain on the sale, that gain is passed on to all investors of the fund. That means you can end up with a tax bill. Even if you do net sell a single share. Ultimately, assets are bought and sold every time an investor enters or leaves an index fund. And anytime there's a capital gain, every investor that's part of the fund will need to pay capital gains tax. But it does matter if you're going to do any day trading or shorter duration moves. Therefore, index funds and they have a low expense ratio. Now, both index funds and ETFs will give you diversification because they hold a variety of assets. Previously, ETFs were known to carry lower expense ratios compared to index funds. But that gap has been closing, and the expenses for index funds and ETFs are now quite similar. So, you're going to see expense ratios in the 0.05% to 0.02% range, which is a fraction of 1%, a very low-cost solution. And index funds and ETFs generally outperform active fund managers over a longer period of time. And I buy it from you. So, it's simply traded from you to me, like a stock. I hope that helps to clarify what is going on. But if you're trying to find a place where you can park your money, your excess cash as an investment, I want you to be aware of the differences that could make an ETF or an index fund a deal breaker for you. For example, you can buy as little as a single share of an ETF. In some cases, you can even buy fractional shares of an ETF. But with some index funds, they're going to impose a minimum requirement. It could be $1,000, it could be $2,000, or even more. And you can do it passively. Just check up on it, passively and conveniently. Then index fund investing might be a really good fit for you. That's generally because active managers capitalize better during the market recovery phase. They have more similarities than differences. In other words, when the markets are going up, an index fund tends to do better, a well-diversified index fund. But then additionally, you could complement that by buying the stock picks that you like. You can think of it like this. Let's say that you, me, my brother, your neighbor, and my Uncle Bob are all pooling money together. With this pool of money, we go in to buy all the stocks in the S&P 500. Let us just say we do that, and let's just say that you want out. When you want to cash out your portion, the fund has to sell some of its holdings to pay you out. You can park the majority of your money in that vehicle, the S&P 500 index fund. However, if you really have that itch to buy and sell individual stocks, well, you can have the majority of your money in a broad index fund like that. Let's just say, well, you really think Tesla is going to do good? Or you really think Google is going to do good? Then you could have the bulk of your money in an index fund, and you could use smaller amounts of money to make your stock picks. But the bulk of your portfolio will revolve around index fund investing. When the markets are going down, active management tends to do better. If you're not paying attention to the economy, if you're not staying current on the sector, and if you can't read financial statements, well, that probably explains why. It's hard for even the professionals to beat the markets. You don't have to manage it. Research shows that from 2001 to 2016, active fund managers underperformed their benchmark index. So honestly, if you put your money in an index fund, you're probably going to do better than most people. You don't have to make these big decisions. If you know what you're doing but are just too busy, let us say you don't have time to research individual companies or pay attention to macroeconomic conditions. This will solve the problem. But for most people, for most investors, I believe that index fund investing does make sense. There are more benefits than there would be cons or negatives. Just think about how practical and convenient it is. You could just throw money into an index fund, and you don't even have to know what's going on. You could just focus on your job, your career, your friends, your family. You could focus your energy and your attention elsewhere. It'll be more stress-free. You don't have to keep up to date on the macroeconomic environment or company-specific news. I understand we're all busy. Life gets in the way, and this may be a good solution for a lot of people to become a passive investor with index fund investing. Let us say you have an index fund that tracks the S&P 500. So, if the S&P 500 goes up 7%, the S&P 500 index fund might go up 6.95%. You might be thinking, hey, where's the rest? Well, that difference includes the cost to run the actual index fund. Sometimes the tracking error may be tiny, like a difference of 0.01%. But with other index funds, it may be much more. There also may be tracking errors if an index fund uses derivatives. In those instances, an index fund will not track precisely. If the S&P 500 goes up 1%, that index fund will likewise go up 1%. If the S&P 500 goes down 1%, then that index fund will go down 1%. How an index fund works? Let me explain how an index fund actually works. Now, I want you to really think about that, because there are pros and cons to this. Let me tell you what they are. Index funds? Pros and cons. We'll start with the cons of index funds. For example, if you invested in an S&P 500 index fund, then you cannot beat the markets. So, if you want to become a superior investor, an index fund may not be right for you. Cons of index funds. Because index funds mirror the markets. That means that if you invest in an index fund, you cannot outperform that benchmark. Another downside with index funds is the lack of flexibility. And another drawback is tracking error. An index fund will not perfectly track an index. Okay. So we just got all the bad stuff out of the way. Pros of index funds. The great thing about an index fund is that you can be... Here's another benefit. The truth is, most people are not good at picking individual stocks. I do want you to know this though, because most people overlook this part when they talk about index funds. Recently, passive investing through index funds has been outperforming. Another big benefit is diversification. Here is what I suggest to you. Compare the pros and cons, and see if this makes sense for you. My opinion on index fund investing. I hope you found that educational information helpful, but I want to share my opinion as well. This is like a heart-to-heart about index fund investing. If you're asking for my opinion about index fund investing, I believe it depends on the investor, on the individual person. So there are a lot of benefits that you have to take into consideration. But I do want to say one last part, and this is especially important for beginners. And the other approach is that if you do want to park most of your money, the majority of your money, with a broad index, let's just say an index fund, an S&P 500 index fund, right? How many index funds should you own? That's going to depend on how diversified a particular index fund is. It is very important that you understand this. There is no one right way to invest in the stock market. In this section, you'll get a better understanding of whether 1, 2, or all 3 are a good fit for you. I'm going to answer Asterisk. How are index funds and how do you know which one is right for you? Index funds versus ETFs, similarities and differences. I'm going to tell you the truth. They have more in common than not. Let me demonstrate what's going on with an index fund. Now let's compare this to an ETF. With an index fund is a collection of securities that are financed by a pool of investors, but there are a lot of similarities. And let me tell you what those are. Index funds and ETFs are both passively managed. Now, I want to tell you the differences, and this will help you determine which one is better for you. Let's get started with liquidity. You can buy and sell ETFs throughout the trading day, like a stock. Moving on to minimum investment requirements. Generally, an ETF will have a lower minimum investment requirement when you compare it to an index fund. When it comes to expenses and fees, both index funds and essentially, with an ETF, you're selling to another buyer, and the cash comes directly from that buyer. My opinion, index fund, or Now let me tell you what I think. My opinion is that an ETF is an upgraded version of an index fund. Here's why. If you're on a tighter budget, an ETF may be better for you. If you have less money to invest up front, I want to be clear that I do like index funds. But if I had to choose, then I would go with an ETF. But that is just my opinion. If there's a particular index fund that does not have a competing ETF, then yeah, I would buy that index fund. So, that's just the way I see it. ETFs do have a better tax structuring, and that's going to give you greater control of claiming gains or losses. That's because a bull thrusts its horns in an upward motion. When you have high inflation, most things will go up in price, including stocks. That's because a bear swipes its claws in a downward motion. People use the term bear market when the stock market has fallen at least 20% from its peak. The average bear market lasts for 9 months. When the Federal Reserve prints money, that's quantitative easing. When the Federal Reserve takes that money back, that's quantitative tightening. Quantitative tightening tends to be harmful to the stock market. If the Federal Reserve is pulling money out of the economy, there's going to be less money to go around. If there's less money to go around, there's going to be less money in the stock market. It's a simple two-step process. This means that the price of stocks will generally go down, so it's pretty straightforward. Quantitative easing pushes the stock market up, quantitative tightening pushes the stock market down, and you can filter your search for which stocks you want to look at based on company size, stock price, industry, trending stocks, popularity, etc. That's one method. On average, you can expect the stock market to fall by 36%. Therefore, you can understand why most investors do not enjoy a bear market. So stock prices tend to go up during quantitative easing. That's just because there's simply more money in the economy. Your money's on the line. You want to make sure that you do your homework to maximize your odds, that you pick a winner. If you get stock recommendations from a newsletter, a subscription service, a friend, a family member, or a coworker, it doesn't matter where it comes from. Always do your own research, because in the stock market, you can make money by betting that stocks will fall in price. A brokerage account is where you buy and sell stocks, and the majority of brokerage accounts have zero commissions. My honest answer is, they're all the same. Now, of course, there will be exceptions, like if you're a professional day trader, but for the vast majority of investors, it doesn't matter if you have $1 million or $100. Any name brand brokerage account will be good. I am going to leave a link for you down below to a good brokerage account that I use personally. If you use that link, you'll receive a sign-up bonus of free stocks to kickstart your account. That means it costs you nothing to buy a stock or to sell a stock. Please subscribe, and I wish you a very nice day. Happy investing. They don't charge you anything. It's literally free. That's because these brokerages have other ways of making money. They make money from lending, from interest, from market making, so they make money in a lot of ways, not limited to just those. So they don't even bother charging you a commission to buy or sell stocks. In the stock market, most investors make money by buying a stock at a low price and then selling it at a higher price. However, you can switch the order around. You can sell high and then buy low. You're doing the same thing, just in the reverse order. Some investors will pay more attention to sales growth, others to profits or dividends, price to earnings, ratio, cash flow, the charts, etc. Your evaluation will most likely encompass a variety of these factors. So everyone has their own style of stock picking. Therefore, when you're shorting a stock, you're hoping that the stock goes down in price. If you want to make money shorting a stock, then you should be searching for companies that have a very bad future ahead of them. This could be bad management, a dying industry, a product or service that was just a fad, too much debt, competitors that are out competing them, etc. When you're looking to short a stock, you want to make sure that they're as bad as they come. The more terrible, the better. All that newly printed money needs to go somewhere, and a lot of that money finds its way into the stock market, driving up the price of stocks. In a bull market, there will be ups and downs along the way, but the general direction is up. A bull market can last for a few months or for many years. The average bull market lasts for 3 to 4 years. During a bull market, most investors are making money because, on average, stocks gain 110%. A bull market is good times, and that's why people love it. Everyday investors enjoy watching their account values go up, and it's a great time all around. A bull market can be triggered by various factors, such as a booming economy or quantitative easing. However, personally, I like to pick my own stocks in addition to index funds and because you can buy or sell an ETF throughout the day. If that need ever arose, you could take advantage of any major price movements throughout the day, and that is a benefit that you cannot have or do with an index fund. So in this segment, I want to explain to you 10 common terms that every beginner in the stock market should know. I'm going to teach you the lingo and some key concepts. However, some of these ETF advantages might not make a meaningful difference to you, especially if you're a long-term investor. To be clear, both index funds and ETFs have my stamp of approval. 10 essential stock market terms for beginners. In addition, it's very important that you know the common stock market terms that you'll hear very often. 1. Bull market. When the stock market is going up, people call it a bull market. 2. Quantitative easing. This is when the Federal Reserve is printing money, which causes inflation. 3. Bear market. When the stock market is going down, people call it a bear market. 4. Shorting. When the stock market is going down, not everyone is going to be sad though. 5. Quantitative tightening. We spoke about how quantitative easing is money printing. Quantitative tightening is the very opposite of that. $6 cost averaging. When you buy a stock, you never want to go all in. So let's just say that a stock is at $10, and you think it's a good price. Don't act like a crazy person and use all of your money to buy it at $10, even if you think it's a good price. So sure, you can buy some at $10, but save some money in case it drops to $9, and save some money in case it drops to $8. By doing so, you'll be averaging down on your purchase price. In this example, let's just say that you thought it was a good price at $10, and let's say that nothing has fundamentally changed with the stock, and on no news, the stock falls to $9. So this would be a great opportunity to DCA down and buy more shares at a cheaper price. A benefit of dollar cost averaging is if you buy some at $10 and then it goes up, then you'll make money. If the stock goes down, then you can buy more shares at a cheaper price, and this will allow you to make even more money because you got in at a better price. 7. Tax loss harvesting. This is when you're selling, you're losing stocks, taking the loss so that you pay less taxes. 8. Support and resistance. These are very important terms that you're going to hear often. A lot of people in the stock market like to look at the stock charts and identify patterns. If there's a certain price that a stock has a hard time falling below, that's called the support. If there's a certain price that a stock has a hard time going above, that's called the resistance. In a lot of cases, when the support is broken, it will turn into the new resistance. And a lot of times, when the resistance is broken, it will turn into the new support. Finding and evaluating good stocks. Now let me tell you how to find good stocks to buy. Step 1. Discovery. How do you even find companies that are listed on the stock market? And the answer is simple. There are multiple ways. There are many free websites that list all the companies on the stock market. Another method is that you can find stocks by reading financial news outlets like Wall Street Journal, Google Finance, Yahoo Finance, ETSE. Another method is that you can subscribe to free newsletters about stock picking. There are even paid subscription services for stock picking. You can always ask your friends, family members, or coworkers. Step 2. Evaluation. This is very important. Do your due diligence before investing your hard-earned money into a stock. And I want to tell you this, there is no one right way to evaluate a stock. Where to buy and sell stocks? Now let me give you my honest opinion about where you should buy and sell stocks. The question is, which brokerage account is the best? Where should you open up a stock market account? I hope you learned something and enjoyed this video. Thank you so much for the support.